Look around. We're living through a moment where the old rules for money are being rewritten. For decades, the playbook was clear. When the world got shaky, you sought safety in government bonds, maybe gold. But today, with sovereign debt at record highs and geopolitical conflicts flaring up across the globe, that playbook feels out of date. We're seeing a powerful new narrative emerge, one that positions Bitcoin not just as a speculative asset, but as a genuine geopolitical hedge. This isn't just about price moves, it's about a fundamental shift in how capital seeks safety in an increasingly uncertain world. It's about finding a haven when traditional ones start to look less secure. So what's actually happening? We're seeing a potent cocktail of two major forces. First, governments worldwide are carrying unprecedented levels of sovereign debt. Think about it. The sheer scale of borrowing has never been higher. This isn't just an abstract number. It means governments are stretched, and the stability of their currencies and bonds can feel increasingly fragile. Second, we have a backdrop of escalating geopolitical conflicts. From regional skirmishes to global power plays, the world feels more volatile than it has in decades. When these two forces converge, a mountain of debt and a landscape of instability, the market starts to ask serious questions about where true safety lies. Why does this matter to your money? Because these converging forces erode trust in what were once considered rock-solid safe havens. Historically, when things got tough, investors flocked to the bonds of stable governments. But if those same governments are drowning in debt, or if their geopolitical actions are creating instability, then the concept of a safe government bond starts to lose its shine. Capital, by its nature, seeks security and freedom from seizure or censorship. When the traditional options feel compromised, the market starts to re-evaluate where to park its value. This isn't just about fear, it's a rational response to a changing risk landscape, pushing capital towards assets perceived as truly independent. So, how does Bitcoin factor into all of this? The mechanics are fairly straightforward. Bitcoin is a decentralized digital asset. That means no single government or institution controls it. It's also censorship-resistant, meaning transactions can't easily be blocked or reversed by an authority, and assets can't be seized in the same way traditional bank accounts or physical gold might be. Its supply is finite and programmatically predictable, a stark contrast to fiat currencies that can be printed at will. This combination of features makes it attractive to capital looking for a non-sovereign store of value. Think of it as a modern, digital alternative to gold, but with the added benefits of easy transferability and divisibility across borders, without the need for intermediaries. It's important to understand this isn't just a Bitcoin-specific phenomenon. My read is that this narrative is driving a broader rotation into the crypto space as a perceived hedge. We're seeing interest in other non-sovereign digital assets too, suggesting a wider search for alternatives. This isn't a retail-driven frenzy, it's a more deliberate shift. When you look at traditional retail indicators, they're often down, while interest in liquid, institutionally accessible digital assets is up. The key dynamic to watch here is whether Bitcoin and other major digital assets continue to decouple from traditional risk assets during periods of heightened systemic stress. If they move independently, or even inversely, that narrative of a true hedge only gets stronger. Moving forward, what are the concrete levers and signals to watch? First, keep an eye on sovereign debt management. Any significant expansion of government bond buyback programs, like what we've seen from some treasuries, could temporarily stabilize things. But if the scale isn't massive, it's just a band-aid. Second, watch for escalation or de-escalation in global conflicts. Each new flashpoint, or the resolution of an existing one, will directly impact the perceived stability of traditional markets and the appeal of non-sovereign assets. If conflicts intensify, the hedge narrative strengthens. If they ease, it might soften. The third signal is Bitcoin's correlation to traditional risk assets. If it continues to show a low or negative correlation during market downturns, its role as a hedge becomes undeniable. If it starts moving in lockstep with stocks again, that's a different story. This re-evaluation of safe havens is one of the most significant shifts happening in markets right now. Understanding these underlying dynamics is crucial. For a deeper dive into the data, my full breakdown, and how I'm tracking these geopolitical hedge narratives, head over to korra.finance. We'll keep you informed on what actually matters.